This is Bloomberg Surveillance Early Edition with Dani Berger and Kriti Gupta.
It's 10 a.m. in London, 5 a.m. in New York, 5 p.m. in Hong Kong. Our top stories today. It's the countdown to the U.S. CPI print. Investors gear up for inflation data that may reinforce the argument for September Fed pause. Disney gains, cost cuts, and the Hollywood strike save the entertainment giant $3 billion. And China lifts a ban on group travel to several countries, including the U.S. and U.K., in a major test of travel demand. Meanwhile, Beijing responds as President Biden limits investment in Chinese tech. Welcome to Bloomberg Surveillance. You're watching the Early Edition. I'm Dani Berger in London. Kriti Gupta is in New York. And Kriti, on this Thursday, happy CPI Day to you.
I was going to say that to you. You completely ruined it. Well, you're seeing a little bit of optimism in the markets this morning, perhaps a little bit of optimism around that CPI. Remember, we were already seeing a much faster than expected deceleration going back in the last couple of readings. So what's interesting here is that you are actually seeing optimism ahead of the CPI. That is not normal. You tend to see a little bit of a sell-off. So seeing a little bit of a reversal to the usual trend. Futures higher, though, by about 0.6%. NASDAQ 100 futures is where all the action is, though. Tech outperformance seems to be the name of the day, higher by about 0.6% there. Look, you do have some good Disney earnings coming out as well, so that is going to impact the indexes simply because of the weight that Disney holds. But it's also a pretty broad gain this morning. If you look at it from a micro perspective, almost all of the stocks that are trading this morning are higher, not lower. So that's actually some good news when you're talking about breadth. But again, what happens when we get that CPI data down? Is this one of those kind of buy the news, sell the room, or buy the rumor, sell the news? Excuse me. 10-year yield, though, also again waiting for that direction from the CPI. 402 is where we'll call it. Again, technicals really matter here. We've been hovering around that 4% level for the bond market for some time now. Again, the CPI could change everything, Dani. Of course, the Bloomberg Dollar Index actually diverging a little bit from what you're seeing in the bond market. Even in the front end of the curve, the dollar actually weaker right now to the tune of 0.2%.
I do think that's interesting. The bond market might be holding steady for the most part, but you are seeing directional bets being put on the equity and FX markets, and they are risk on. Look, a large part of why we're seeing stocks being bought in Europe is because of news we got out of China. We're going to talk to a reporter about this in a moment, but we learned that China is going to be permitting group travel from the region to places like the UK, Europe, Japan, and we've seen a big rally, especially in French stocks, especially in consumer stocks. LVMH, by points, the biggest gainer in the stock 600 in today's session. CAC up 1%. That weaker dollar also translating into a stronger euro this morning. We're back up above 110. So optimism, perhaps, that CPI will show another month where inflation is on target with the Fed's 2%. But the other reason we seem to be bidding the euro is because of fear of inflation in Europe. Nat gas had a huge jump yesterday. Let me show you the two-day move, because there were strikes in Australia, or potential strikes, I should say, in 3 different LNG terminals in Australia. It compromises about 10% of the global supply. So yesterday, nat gas jumped some 28% on that in Europe. Now, whether or not this will actually impact Europe majorly, unclear, considering we do have a large stockpile, considering industry is sluggish. But it shows how vulnerable Europe energy and the energy complex is. We have come back down off of the heights of that level, Kriti. But still, this to me really spells out the fragility of European inflation and European energy supply.
Well, it's interesting that you mentioned the inflation story, because, of course, that's going to be the key focus stateside. Stocks already higher in anticipation of that. Bonds not doing much. The dollar pulling back. A little bit of a mixed picture. Of course, that inflation data coming out at 8:30 a.m. Eastern time. Investors waiting any clues for what the read-through for the Federal Reserve might be. Bloomberg's Valerie Teitel joins us now for a preview. Valerie, take it away.
Look, it's really going to be about the core print today, especially the core month-on-month print. We're really interested not in the year-on-year changes in inflation. We really want to laser focus on how it's going month-on-month, and we're expected to get another 0.2 print that would mirror last month's 0.2 print. And Kriti, this is great news, because if you annualize a 0.2 print, that gets us very close to the Fed's 2% target. So if this does come from at estimates. If we do get that 0.2 month-on-month for core, we really should expect these Fed members that we hear from later today to sound more dovish. Perhaps we hear a few of them really stick their neck out this time and solidly call for a pause in September. If we get a softer print, maybe a decent equity rally we'll have on our hands. A mission accomplished feeling in the market will start to grow, and expect earlier rate cuts to start to be priced in. We're now pricing a 15% chance of rate cuts come December. That could grow if today's print comes in soft.
If today's print comes in soft, what then will happen 4.5 hours later when we get a 30-year Treasury auction come into the market?
It's a big duration event for the market. This is the first of the upsized Treasury auctions for the 30-year bond. It is a lot of duration that is going to hit the market. But, Dani, we have had the two previous bond auctions, or the two previous Treasury auctions, go pretty well this week. Stellar 3-year auction on Tuesday and a pretty solid 10-year auction yesterday. It's really putting to bed maybe some concerns that we could see this aggravated steepening of the curve given all this Treasury issuance this week, but we'll see later today.
Bloomberg's Valerie Teitel walking us through everything we need to know for that CPI report later today. We thank you as always. We go from the macro to the micro. Earnings news. Disney shares are rising in the pre-market to the tune of 1.2%. Company reporting lower than expected spending for movies and TV shows amid those extensive cost cuts. CEO Bob Iger spoke on the earnings call.
Perhaps most importantly, we've improved our DTC operating income by roughly $1 billion in just 3 quarters, as we continue to work toward achieving DTC profitability by the end of fiscal 2024.
Disney also raising the prices of its streaming services, including a 27% increase for their advertising-free version of the flagship Disney Plus. For more on these results, let's get to Bloomberg's Aggie Cantrell. Aggie, there's a lot to digest with Disney. They do a lot of different things, but I think for me, as Dani knows, I'm very obsessed with the labor story. Let's start with the Hollywood strikes. How are they feeding into those cost savings?
Yes, Kriti. So I'm also pretty obsessed with this story because I think that this is feeding into the broader story that we haven't really seen yet. And so if we're looking at those strikes, those cost savings are massive, 27 billion. Typically, they would expect 30 billion in content spend. That's a huge drop. And so right now they can bill it as, hey, look, we're actually committing to cost savings. They have, of course, committed to layoffs within the company as well. And so there is part of this, which is that they are managing to currently save on the spend because also a lot of things have had to be put on pause.
We also have these cost savings, though, coming at a time when streaming subscribers have fallen significantly. Is their path sustainable?
Yes. So firstly, of course, as Kriti mentioned earlier, the price hike in Disney Plus is going to be something that people will be watching closely to see if that's actually going to have an effect on subscribers. But also this quarter, the subscriber drop that we saw, a huge part of that was actually because they lost the rights to the Indian Premier League cricket, which essentially accounted for a huge amount of their subscriber loss this quarter. But what I want to see going forward is potentially if these strikes continue, then there will be a concern that they are not bringing new content onto the platform if the writers aren't coming to the table. And that also means that essentially potentially subscribers will get bored and feel like there's nothing new to watch.
Yeah, again, it's pretty remarkable how just losing the rights to cricket matches, the Indian Premier League, can have such a large impact, although not surprising. Aggie, thank you so much. Aggie Cantrell there. All right, let's turn to China. It's lifted a ban on group travel to a slew of countries, including the U.S. and U.K. It's a major relaxation of travel restrictions that could boost global tourism. Let's get over to Bloomberg Asia government and politics correspondent Rebecca Chung-Wilkins. Rebecca, why now, and what will be the impact of this for tourist destinations?
Yeah, absolutely. I mean, I think there is a desire, given the sort of sluggish economy worldwide, to see Chinese tourists return. But there are a couple of challenges there too. I think on the one hand, China is trying to signal that it's once again sort of open to the world. But there are a couple of domestic issues. The first is that China economically is in a rather weak position here. We just don't see consumers wanting to spend. Again, they also tend to favor domestic travel, particularly particularly after 3 years of COVID, flight capacity still very low in and out of China. The other element is the geopolitics of it. We have seen tensions with the US and with the US's allies really rise. And I think there is some concern among Chinese folks about how they may be received if they go on these trips. We did have a recent Pew Research Center report noting that a record 10 of 24 countries they surveyed are seeing negative sentiments toward China at record highs. So there is a shift here, a significant shift in what the environment looks like for Chinese tourists too.
Certainly a lot to digest. And at the same time, President Joe Biden imposing limits on U.S. investments in China. What's China saying about that?
Well, we did see what we would typically expect, a rather robust response. China saying, quote, it's very disappointed with the move and the decision to go ahead. We had the spokesperson for China's embassy in the US accusing the US of politicizing and weaponizing trade and issues of scientific technology and development. And we had the Ministry of Commerce coming out reiterating what we've heard before in response to curbs, that it reserves the right to respond. I will say, despite those rather harsh words, you know, in the backdrop, there may be a little bit of relief. The sort of line coming out of the White House themselves is that this is, you know, a high fence and a small yard, and does reflect some of that conservatism we saw from the Treasury, not to make a really sort of expansive sweep of companies that fall under potential curbs. And that was part of what Beijing was lobbying Janet Yellen for during her trip in recent weeks. So potentially some amount of conciliatory sort of response there.
Rebecca, the other China story we've been watching are any developments with the property developer China Country Garden. It seems like this fear of what a default for them would mean on a global scale has really caught everyone's attention. And we learned recently that China's securities watchdog plans to hold a meeting on the real estate market on Friday. What's going on there? What are we expecting to come out of this discussion?
Yeah, this is a really interesting story, and perhaps to me the clearest indication of a divergence. Now, regulators, as you say, are holding this meeting with property developers and with financial institutions. Now, source has said that that meeting is not going to include Country Garden, and another source has said that it's going to be, or has been called specifically by the corporate bond department of that regulator. So it underscores this longer-term need for Chinese property developers to be able to return to capital markets. If that business model is going to be restored, they will again at some point have to be able to come back to borrow. Now, separately, Country Garden, which as far as we know has not been invited to this virtual meeting on Monday, is still really facing heavy amounts of scrutiny. There are these really serious concerns about a default, that it, you know, is having to use this 30-day grace period. The coupon total there about 20 million. It's not an enormous amount. The issue is Country Garden, when I first started covering it, was China's largest developer just a few years ago. It's still number 6. It's a major player, 4 times as many projects as Evergrande. So the consequences both for the sentiment, if we see a large player like this, a player that was once considered one of the safest in this sector, fall, and will really sort of damage that sentiment, just as Beijing is trying to restore confidence that developers will survive and that the property market is going to get back on its feet, and most importantly, that prices are going to start rising again, or at least stabilize, because so many of China's middle class have been hit by the sort of scare in the property sector. It is the largest asset for many, many of China's middle class.
Rebecca, thank you very much. A lot of strands to keep track of there in China. Thanks for helping us do it, Rebecca Chung-Wilkins. Now, coming up on the show, Novo Nordisk struggles to meet demand for its blockbuster obesity drug. We're going to more on the company's financial results next. And later this hour, we're going to get back to the U.S. inflation data with Anneka, Treon, chief economist at Van Lanschot Kempen. This is Bloomberg.
I believe that treating obesity is going to be one of the healthcare interventions that's going to have the strongest return in terms of preventing diabetes, cardiovascular disease, a number of cancers. There are more than 200 comorbidities linked to obesity. So yes, I do believe that for payers, this is going to be a very attractive proposition, and increasingly so with the latest data we have reported.
That's the Novo Nordisk CEO discussing the drug maker's struggles to meet demand for its blockbuster obesity drug. For more on their earnings and what we learned, Bloomberg pharma reporter Naomi Kresge joins us now. Naomi, you had written and the team had written this great piece about the frenzy, about the shortages that were arriving because of everyone wanting these weight loss drugs. What did the CEO there, we heard a bit of it, lay out in terms of just how far behind they are in supply?
So we saw today that they have just been reluctant to say exactly when they're going to catch up to demand. They say that they're adding supply and continuously working to do this. But he this morning said, we don't know exactly what demand will be, and so we can't say exactly when we're going to meet it.
Naomi Kresge walking us through that earnings story. We thank you as always. We go from Novo Nordisk to Siemens. Their earnings falling short of analyst estimates as the company saw demand for its digital industries unit drop in China, all while taking a hit on its stake in the troubled wind turbine maker. Siemens CEO spoke to Bloomberg's Oliver Crook earlier.
We are very much disappointed with what happens, so that the quality issues are not getting under control. Let's see what the next measures are, but I do believe they have a strong team in place and they will make it. They will solve these problems. I hope it doesn't take too long.
Oliver Crook joins us now from Berlin. Oliver, walk us through kind of what stood out to you in the earnings story.
Yeah, so you had that Siemens Energy issue. They had to take a loss of 650 million euros, and that's because they still have a 25% stake in the company. That said, they did sell a big chunk of that back in June after a face-ripping rally for Siemens Energy, up 130-some-odd%. But really the standout for me was China. Their orders were down 35% in China. So that fear of the slowdown is very real there in Siemens. This was supposed to be a tailwind in the back half of the year. That is not materializing. Now they're going to say it's going to really be a handbrake, actually, for a number of quarters to come. If you take a step back, however, they've raised their outlook already twice this year. They've confirmed their forecast, and they're sitting, and this we should not forget, on a record backlog of 110 billion euros worth of orders still to come. So really, even if there's a bit of a sales slowdown, I should say, they still got that cushion.
They have that cushion, but Oliver, can we get back to this question of Siemens Energy and what's happening with their wind turbine unit? I mean, how long is this going to be a drag on the company? Because this is clearly the sticking point, not just in their earnings, but again, Siemens Energy earnings too.
Yeah, so listen, they're starting to sell down their stake. They still own 51.1% of this company, which is why it's slowing them down. I asked the CEO, he was like, listen, ask the CEO of Siemens Energy. But basically, it's very hard to say. There's been an enormous sell-off because investors do not feel that they have confidence in the fact that they have their arms around this crisis. And just to remind people, this is about defects and some sort of manufacturing issues that some of these wind turbines have. And overall, it's been a challenging context for wind. They've not nailed this pricing model, and particularly with, interest rates going up, these projects become very, very expensive to develop. And, they haven't always been able to get that back when, say, energy prices surge up just because of how they've constructed these projects.
Right. Yeah, that's a good point. Oliver, thank you very much. That's Oliver Crook there speaking with the Siemens CEO. Now, coming up, we have some other German earnings news for you. Allianz second quarter profit jumped as its insurance business outshined its asset management unit. This is Bloomberg.
The retail business performance is very resilient, so we are reacting to the inflation that we are seeing. So from that point of view, we are also pleased with the resilience that we see in the retail business. And then I would say in the life business, the new business margin continue to be very strong. That's a reflection of the efforts that we put over the last years to improve the profitability.
That was the Allianz CFO, Julia Tetzriel, speaking to me earlier after the firm posted a jump in profit thanks to its strong earnings from its insurance business. Even though, Kriti, there was still some weakness in its asset management unit. The market liked it. Shares are higher by 3%. But they are trying to make this change when it comes to PIMCO. I find this really interesting. I asked Mr. Tetzriel about it, and they are basically changing the direction of PIMCO. We know its DNA, since Bill Gross founded it, is about bonds, but they don't see a future where they can just be sustained on active bond funds. They're trying to get more into alternative asset managements. He told me they're going to do some more bolt-on acquisitions, but that indeed is a pretty big sea change, again, for PIMCO, which we associate with treasuries.
Yeah, I mean, it's a massive one. Of course, the PIMCO calls are so enormous as well. I think what's also interesting is their munis business. Of course, we know PIMCO all out in California. So, of course, the California muni story always remains of interest as well. Dani, of all of the earnings stories that we got from Allianz, the part that stood out to me was their insurance unit, because we're talking a lot about the earnings story simply because of the margins. And you're seeing this in a lot of corporate stories on both sides of the Atlantic. It didn't occur to me that the margins of a insurance business could rise by 10.8%, or in something like life health insurance, an increase of 23%. Those are some pretty substantial numbers coming out of an insurance company.
Yeah, and not to mention wildfires, heat, extreme climate that they're dealing with in their insurance business. Allianz saying that they want more help from the government in order to tackle that it could be an opportunity to insure more of these types of markets. 90% of Europe that faced wildfire damage was uninsured. But he basically said, look, we can't do it. The math doesn't work unless governments step in too. Okay, coming up, we're going to talk about U.S. CPI and speak to Anneka Treon, chief economist at Van Lanschot Kempen. That's next. This is Bloomberg.
This is Bloomberg Surveillance Early Edition. Here's what you need to know. It's the countdown to the U.S. CPI print. Investors gear up for inflation data that could reinforce the argument that in September, the Fed has to pause. And Disney gains, cost-cutting, and the Hollywood strike saved the entertainment giant $3 billion. Meanwhile, over in China, they're lifting a ban on group travel to several countries, including the United States and the UK, in a major test of travel demand. Meanwhile, Beijing also responding to President Biden limiting investment in Chinese technology. I'm Kriti Gupta in New York with Dani Burger in London. Dani, a lot of cross currents here, already seeing some optimism. It feels like on both sides of the Atlantic, but I think that could potentially all change with that CPI report on deck.
Yeah, we have pared back most of the gains we've seen in Europe. Maybe it is just we did start the day with a pretty big risk on rally. Do you really want to put that risk on right before a very large CPI print? Large in terms of importance, not necessarily in terms of number. But really what has been driving European markets is what you mentioned, Kriti, in terms of China lifting a travel ban for group travel to places like the UK, like Japan. We saw a lot of the consumer stocks, luxury, do really well. Cacaron French stocks outperforming off the back of that. Euro, though, that continues to gain. That perhaps is some positioning that we expect that inflation will once again be consistent with the 2% target. Euro gaining, strengthening 0.4% versus the dollar. There are also inflationary fears, which over the past 24 hours reared their head again in Europe, specifically when it comes to energy. Nat gas jumped some 28% yesterday when three potential LNG ports in Australia looks like they might go on strike. Now, nothing has necessarily changed, but perhaps the rally was a little bit overdone. We've come in about 5% from the peak. That's how much we've dropped about today. But still, inflation is on everyone's minds, Kriti, be it here in Europe with energy or the CPI report later today.
Yeah, and I think some of that, perhaps great on screen, you're seeing, at least in the equity market, Dani, is kind of flooding into the U.S. session. But there's also the earnings story to keep in mind stateside as well. Those Disney earnings, they were a very good number at a time when a lot of people were expecting a bigger pullback. And that's going to filter into the likes of the S&P 500 and the NASDAQ. Already seeing that tech outperformance in those NASDAQ 100 features higher by about 0.6% relative S&P futures, which are only higher by about 0.5%, 45.10 on those contracts. But also keep an eye on the bond market because, Dani, to your point, the inflation story, the core CPI story still remains an issue. I think that's where you're really going to see that technical analysis hop into the bond market. I think there was a great story on the Bloomberg terminal. I think you flagged it to me, that if you start to see a move of 1% or more, you could actually trigger some sort of selling or some sort of positioning story. And that's going to be something we're going to be watching and exploring in the back half of the show as well. In the meantime, the Bloomberg Dollar Index really diverging from what you're seeing in the equity and bond market, actually weaker by 0.2%.
I do just need to say it wasn't me that sent the story. It was our excellent producer, Natalie Pack. She gets all the credit for that. I'm definitely not gonna steal that one from her. Kriti, I want to dive more into CPI. Really just set the backdrop for today. For our radio listening audience, I have a terminal in front of me that shows both year over year, that's this blue line, and month over month core inflation. That is the bar chart. Now, year over year perhaps isn't as important in this report. It's going to be the month over month impact because last month core inflation came in at 0.2%. Current expectations is that month over month core inflation will come in at 0.2% yet again. So a second consecutive month, a figure that would be consistent with the Fed's 2% inflation target. So what would that mean for us? Let's bring Anneka Treon, chief economist at Van Lanschot Kempen. Anneka, thank you so much for joining us before the CPI mayhem in a couple hours later today. Look, if we get core coming in at 0.2% month over month, does that significantly shift the balance to the Fed being done with rate hikes this year?
Hi, Dani. Well, I certainly hope not. I hope that the Fed's philosophy around this is driven much more than just, the latest data points, of course, because last month was quite a positive surprise that core inflation looked like it was starting to ease. Let's see if the same thing occurs this time round. You're right to talk about month on month versus year on year because of base effects, which are actually quite important this month versus last month. But, the most important thing right now is to zoom out and to consider the factors, especially of fiscal policy, leading to a much more structurally inflationary environment. And how is the Fed going to behave in such an environment? How are they going to think about this 2% target going forward?
It's an argument we've heard a lot, Anneka, that things like the Inflation Reduction Act, the CHIPS Act, they've been fueling demand in the U.S. They've been fueling and acting against central bank policy. But look, we're heading into an election year. It's unclear that anything will necessarily change. How does the Fed need to react? Is there a risk that they overreact in trying to combat some of those fiscal impulses?
Yeah, so Dani, I think the Fed has two options. It's quite straightforward, actually. Option one is stick to that 2% target, restore credibility. That's one of the biggest issues the Fed has had in the last 1-2 years. Stick to it and do not stop with hawkish behavior until that target is met. And if that's the course of action, that can lead to quite a lot of pain being inflicted because thus far, rate increases have not taken a hit on, for example, labor markets. The economy has held up quite well. So if we're extremely stubborn about that and the Fed talking about a neutral rate of 2.4%, eventually, that could be quite extreme. The other option is saying, well, look, in the last 10-year period, we also didn't meet our inflation target. We were too low. So let's accept a period of higher for longer inflation, which eventually over time could be eroded by things like productivity gains, tech, AI, etc. And let's not be too aggressive. And I think it's one path or the other.
Anneka, I'm so glad you mentioned productivity gains, especially in the AI universe. I'm going to come back and ask you that in a second. But first, I want to ask about the concerns around the labor market. Sure, we're not necessarily seeing that kind of dent in the payrolls numbers necessarily that I think a lot of people were expecting when all those recession calls were taking over Wall Street. But you are seeing a lot of unionization, a lot of labor strikes across the country. So even though they may not necessarily not fall off of the payroll, there's still a lack of work being done at the moment because of these strikes. Are you at all worried about that when it comes to the translation of actual output?
Definitely. And this is why it's so important to, move away from the short term and just zoom out and see what is going on here. Why is the labor market so strong despite all the rate increases we've seen thus far? And of course, it's a bunch of factors. It's the fiscal policy. It's all this enormous job creation coming on the back of that. But it's also structural behavior patterns, preferences from workers, from real people. It's, you know, the shrinking of the labor force, which we've been reading about for the last 10 years, which is finally coming through. And it feels like the COVID moment was a bit of the pivot moment, which is actually making these things stickier, people's preferences, their wishes to retire early. The fact that when you're waiting for a flight and the flight is 3 hours late because they can't source cleaners to clean flights clean the plane in between flights. So that definitely is playing a role. And obviously labor unions, this all falls into the same sort of category.
I mean, the port workers, the airlines, in Detroit, the auto workers, you're seeing it everywhere, not to mention, of course, the Hollywood strikes as well. Anneka, let's bring back the AI conversation then. A big question is just how quickly this technology can develop to perhaps come to the aid of some of the productivity losses that are being felt in the market. In your view, what does the lag look like there?
Yeah, and it's such a tough question, and you know, we can zoom straight back into equity markets again because it's a correlated situation, and I'm going to just divert and come back. But you know, look at the S&P, look at the valuations, look at the equity risk premium. Everybody is complaining about the fact that it's 10 stocks driving all of this, and a lot of what's driving that is AI. So you know, is that justified? Is AI going to be able to generate enough growth to justify why everybody is so excited about these companies? And how quickly are they going to deliver the productivity gains we're hoping for? We don't know. What we do know and what we've learned from previous technology cycles is that the rate of speed can be faster than we expect. It's more the regulatory side, which is maybe unfamiliar, the legal side around it, which, you know, for policymakers to get their heads around things is not straightforward. Could that be a delaying factor? We have to see, but I think that's a very important role in this structural inflation story.
Inflation has come in, you know, as evidenced by that chart I was just showing Anneka, maybe not sustainably, maybe not enough. But in what we've seen so far, how do you judge the amount that's due to monetary policy from the Fed's hikes taking effect versus just a normalization of the pandemic bullwhip?
Yeah, well, so the normalization factors are clear, right? You can look at supply chains, you can look at, you know, new used car prices, food prices as a result of, you know, more normalizing supply chains again. So those factors, you know, you could also turn it around and say, well, that was the artificial factors which drove to the 9%, which are being self-corrected. Fine. Energy prices as well. Fine. But what's maybe more important is, you know, the difference between monetary policy and fiscal policy, and what we've learned in the last 10 years is the wealth effect of monetary policy, QE, low rates, has made the wealthy wealthier, has led to asset price inflation. But the real stuff, less so. By real stuff, I mean industry, bricks, you know, digging holes, building bridges, etc. That real stuff is quite important because, you know, let's not even talk about the IRA and CHIPS Act. Let's talk about what happened in October last year, which was a decision to increase Social Security payments by 7% because of inflation in the US. That sort of fiscal support, literally delivering cash in, you know, the everyday person's wallet, that's inflationary. That's nothing to do with rewiring of supply chains.
Anneka, Treon, we could go an hour debating all of this with you. We thank you, as always, for joining our show this morning and walking us through that important inflationary story. Coming up, a sigh of relief for Disney. Shares rising as the media giant reports lower spending and narrower losses than expected. More on that next. This is Bloomberg. This is Bloomberg Surveillance Early Edition. You're looking live at the Principal Room. Coming up later today, an interview with Diane Swan, KPMG's chief economist. Coming up at 2 p.m. New York, 7 p.m. in London. This is Bloomberg.
Upcoming streaming price increases. And I'm pleased to share that our ad-supported Disney Plus subscription offering will become available in Canada and in select markets across Europe beginning November 1st.
CEO Bob Iger speaking on Disney earnings calls yesterday. Now, the company will be rising streaming prices by up to 27%, and shares are higher by about 1.5% this morning. For more, we're joined by Matt Bloxham, Bloomberg intelligence analyst, who joins us now. Matt, Is this all down to cost cuts, Hollywood strikes? Is that the positive reaction we're seeing in shares?
I think that's a big part of it, and I think that's kind of wrapped up into this kind of bigger picture that Bob Iger's come back and he's sharpened the focus of the business, and that's kind of really helped. And yeah, we're seeing encouraging signs. He said that they're on track to exceed the $5.5 billion cost-cutting target they've given themselves, and crucially, they've improved the operating income at the streaming business by about $1 billion over 3 quarters now. That's still loss-making, but it's moving in the right direction. And he said they're on track to make that kind of break-even during fiscal 2024. So I think, yeah, on that sharper refocusing effort and on the cost-cutting, lots of encouraging news there.
You know, I didn't expect Disney to have such a great read, just given the effects of the Hollywood strikes, et cetera. But they're also dealing with profits coming from the other part of their business, not their media center, their parks, their cruises, et cetera. Matt, put that into a little bit of perspective for us. How important is that part of the business relative to the gains they're making in media?
Yeah, I mean, it's really important. So the parks business in aggregate contributes about 2/3 of their profit. So, you know, it's not so big on revenue, but it's a really important source of income. And, you know, some of the commentary they gave around that was hugely encouraging. The China business is back to where it was. Even the US parks are ahead of where they were pre-COVID. And their cruise line business is going really well. There's something like 98% occupancy rates, and they're adding a couple more ships to that fleet over the next couple of years. So, you know, the value of the Disney brand and all of that content and the way they're able to kind of exploit that through entertainment and experiences continues to be a real banker for them.
In other earnings, tech earnings news, we're going to be getting Alibaba. Also, not that Disney is necessarily a tech stock, but ignoring that for a moment,
they
Matt.
kind of are a tech stock.
Yeah, like a hybrid tech stock. Okay, one that is a pure play tech stock, Alibaba. Usually they report in a little bit over an hour's time. What's going to be the focus for the market?
So the focus there is the China commerce revenues, about 2/3 of their revenues. The market is expecting them to return to growth. There may be 5% growth after a few quarters of decline. I think the question alongside that is what's happening with profitability there, because the China market is hugely competitive. So there are some question marks about whether that revenue gain is going to come with margin pressure as they continue to kind of protect market share. Obviously, the other area that people are interested in is all the units that they're IPOing. They're kind of restructuring into 6 units. A few of those units are slated for IPOs fairly soon: cloud, groceries, logistics. Then questions about the trends there. I think a couple of those units, the focus is going to be on profitability, but the cloud looking for growth to kind of, you know, to kind of point to a bigger midterm future.
Matt, in terms of the geopolitics here, I mean, we're reading so many headlines essentially about the Biden administration putting these blocks on Chinese technology, putting these blocks on access to things like chips, et cetera. How does that factor into the Alibaba story?
I think indirectly, I think particularly if you look at that cloud area, you know, obviously one of the areas that the Biden administration is looking to put the brakes on is the adoption of advanced chips in China. Obviously, cloud services are shifting towards AI. AI is one of the focuses of this new executive order to kind of slow China's development of its own technology in those areas. And also, you know, other executive orders we've seen in the past are trying to limit the export of advanced chips into the Chinese market. So I think it's those kind of areas that potentially that kind of might impact Alibaba and other kind of cloud businesses in China over the next year or two.
But overall, I mean, does this executive order have much in the way of teeth? I think initially we'd expected it to be much more stringent than it's actually turned out to be.
Yeah, that's right. It definitely seems like the doves have kind of won out here in terms of both the timing and the severity of this order. For me, I think that the more significant impact comes from these early orders we've seen about the import or the export of semiconductors and the technology to make semiconductors into the Chinese market. I think, you know, this is more about US investment into startups and specialist technology firms. I imagine those companies can get money, capital from other sources. They might have to redirect a bit, but they'll get that money. So I think it's more those other orders we've already seen that have the more direct impact on China's progress.
Is there also any degree which, look, this thing has now come into the public. We've been waiting for it for a while. But now that it's here, it will be easier to pass further things, to have further executive orders that actually do make stricter rules. Is this the first of potentially many restrictions we'll see when it comes to investment in China?
I think you're potentially right. And obviously, there's been a lot of pressure, not just in the US, but the US on its allies to do similar things. So I think we'll have to see how that plays out. Also, we've seen today news that the UK government's kind of looking at that order and considering whether it should kind of follow suit. So yeah, there could be a spillover effect, if you like, in times coming on. I think to some degree, that this was pushed out in a kind of fairly soft way. I think clearly, it's a delicate situation between China and the US right now. I think they want to continue to kind of improve relations, but also, kind of constrain China. So I think they're going to see how this lands before they kind of consider further action because, they want to calm things down, I think, in reality.
A lot to go through in the tech space. Matt Bloxham, Bloomberg Intelligence, a pleasure to have you on the show, breaking it all for us from Alibaba to Disney. And of course, we go from media giant to potentially another media giant, Z Entertainment, the Indian media company, extending their gain to about 20% after a merger with Sony South Asia Group was approved. Now, some context here. If you are a Bollywood fan, this matters to you simply because you are starting to see India become a real hotspot for foreign investment, and that includes Sony as well. Now, one of the things to note about India's kind of antitrust environment is simply that they are very cautious about letting foreign companies get some sort of stake within the Indian corporate sphere, especially in one of their largest industries, and that, of course, is Bollywood. Nevertheless, it looks like they have now, the tribunal has now approved that merger between Z Entertainment and Sony. So you are seeing a bump in both Sony ADRs, higher by 3.5%, and of course, Z Entertainment. We're going to bring you all the details as we get them. Stick with us. This is Bloomberg.
This is Bloomberg Surveillance Early Edition. I'm Dani Berger in London. Kriti Gupta is in New York. Let's take a look at what's ahead for you today. Now, we're going to get earnings from Alibaba and Ralph Lauren. They're going to release their earnings ahead of the U.S. market open. And then it's the main event. It's U.S. CPI. We're also going to get jobless claims at the same time. Those will hit at 8:30 a.m. Eastern. Fed speak also picks back up. Well, they changed their tone. If we get 0.2% on monthly inflation, San Francisco Fed President Mary Daly will speak at 11 a.m. And then another big auction. This time it is 30-year notes that will hit at 1 p.m., $23 billion worth of them. And then we're going to be hearing from Fed Presidents Bostic and Harker at 3 p.m. and 4:15 respectively. So, Kriti, how that Fed speak shapes up, again, it's hard to make predictions until we actually see those CPI figures hit.
Yeah, and I mean, you're looking at the bond market here, which isn't doing a whole lot of anything, but that's going to change when we get, one, the CPI data, two, the Fed speak, and to your point, the 30-year auction as well. So I feel like there's a lot of bond volatility ahead of us that we haven't yet seen in this session. There is, by the way, also a little bit of stock volatility ahead of us, and you're already seeing that in some of the pre-market movers this morning. I want to bring you through some of them. Disney, of course, top of mind, higher by about 1.6%. Look, they're talking about cost cuts. Their earnings coming in way better than expected. $3 billion of savings. And Dani, some of that did actually come off of the Hollywood strike. How long does that sustain, though, if you start to see some of these delays? And of course, I also want to bring to your attention, as we talk about travel and, of course, the consumer, perhaps Wynn Resorts following under that as well, higher by 2% in the pre-market. They're also expecting to get a gaming license in the UAE soon, so perhaps tapping a new market there as well.
Yeah, I also saw that they had in their earnings folks traveling, Wynn traveling to Macau. Vegas is doing okay. We're gambling again. I guess gambling is kind of one of those recessionary proof things, right? If you want to gamble, you'll do it probably whether you have money or not.
Yeah, but it's also extremely exposed to that kind of consumer discretionary spend, as is, Dani, to your point, luxury as well, which brings me to a deal that is in the news this morning, Capri Holdings and Tapestry. Now, these are not names that are household names, but you will recognize your Michael Kors, your Jimmy Choos, your Versace's. Of course, those are all under Capri Holdings and Michael Kors. Well, there is a report out there that they might be acquired by Tapestry, which is higher by about 0.6%, but Capri rallying by 33% as well. And Dani, very quickly, a quick check on Alibaba shares because those earnings coming out soon, higher by 1.5%. The focus is back on the Chinese consumer, so a lot to watch there.
Yeah, and those should hit in about an hour's time. That's usually what we get back in. We're expecting China to come back to growth for Alibaba, but that still doesn't necessarily mean it's the all clear. All right, that's it for Kriti and me on the early edition. Surveillance is up ahead. This is Bloomberg.